Bank of Canada recently came out with some comments about breaking the glass, talking about Canada's productivity problem and how as a country, Canada has become less productive over the last 7 years. And that is quite a concern because with Canada, we want to make sure that our GDP is growing and that we are advancing as a nation. And when our country becomes less productive, typically when we have high inflation and those folks are not being very productive, we see some negative effects happen to the economy. And I'm not going to get into those negative effects today here on this video. What I wanted to get into on this video is what does that mean to those who have mortgages, especially variable rate mortgages? Well, I was reading some comments here about what break the glass would actually mean in Canada, and that would actually mean that the Bank of Canada would reduce interest rates to stimulate the economy to encourage productivity. However, they would have to monitor this with the intention of making sure that inflation doesn't go up, because if rates do come down before the United States, because the United States doesn't look like they're lowering rates anytime soon, we could see our dollar go down in value, and because of that, our imports become more expensive, those exporting to us, causes a whole big different mess. And with regards to that, they would have higher inflation for the goods and services that are being brought into Canada. There'll be inflationary pressures that way. So even though the Bank of Canada wants to break the glass, so to speak, and drop interest rates and stimulate the economy, they want to do so in a balanced way. And we'll probably see that play out as they look at doing this in the future, but also making sure that inflation doesn't spike. Any questions, feel free to reach out. Follow me on my social media. And if you need financing advice, my name is Joe Bladek. I've been a broker financing real estate for 14 years.